Let's explain cost concept in
We want to
economics.
look at cost concept in economics. In economics, cost refers to the total expenditure a producer incurs in the process of producing goods and services, and it represents the sacrifice of resources and the nature of money, time, and effort to bring about production. For example, if a bakery spends 50,000 naira on flour, 20,000 naira on wages, and 10,000 naira on electricity, the total cost of production then is 80,000 naira. There are two main meanings of cost. We can look at it in this form. One, we can talk about explicit cost. Also, we can talk about implicit cost. Explicit cost means the actual payments made in money, actual payment made in money terms, such as wages, rent, and raw materials. Implicit cost, on the other hand, means the estimated value of resources owned by the firm itself. For example, we're talking about the owner's time or the use of owned properties. Like you're building your car, you are using your car or your building for the business. So these are part of the implicit cost. In economics, total cost then means or is equal to explicit plus implicit cost. Cost can be classified into two major ways. We can talk about the accounting, which is money cost. Also, we can talk about economics cost. In accounting costs, they are the out-of-pocket expenses a firm records in its books. For example, rent, raw materials, wages, fuel, and transport. They are used mainly for financial reporting and tax purposes. But economics costs goes beyond money spent. It includes opportunity cost, that is the value of the next best alternative forgone. This gives a truer picture of what production really costs society or the firm. This means that we are saying that it gives a truer picture of what a production really costs society or the firm. There are types of costs. We can talk about short-run costs. Also, we can talk about long-run costs. Short-run costs. In the short run, some factors like machinery, land, or building are fixed, while others like labor and materials are variable. So the fixed costs, they do not change with outputs. Examples are rent, insurance. Or variable costs are the costs that change directly with level of output. Such include the cost on raw materials and wages. The total cost will be equal to the total fixed cost plus total variable cost. So total cost, uh, we use TC to represent total cost, TFC to represent total fixed cost, and TVC to represent the total variable cost. Now let's look at the long run costs. In the long run, all factors of production become variable. In the long run, all factors of production become variable. Firms can change their production scale, expand factories, buy new equipment, or enter new markets. So in this instance, even your fixed factors will have changed. So when we say they become variable, it means that they change. I mean, they change their levels. change their levels based on the level of output. Now that your scale of production is increasing, there are some of those other factors. For example, you may need to do what? Increase the size of your machinery. You need to increase the size of your warehouse, and so on and so forth. Let's look at the relationship between costs. Economists use several cost measures to analyze production. We can talk about average cost, which is AC, and the average cost is equal to total cost divided by output. In this case, we see that AC equals TC divided by Q. That is, we're talking about cost per unit. So average cost implies cost per unit. Then we can talk about the EFC, which is average fixed cost. And there we say TFC divided by Q. And that falls. It falls as output increases. So as your output increases, the fixed cost, falls. Average variable cost, which is equal to TVC divided by Q. This is U-shaped due to the increasing and decreasing returns. It is U-shaped due to what? Due to increasing and decreasing returns. As you increase the size of your output or size of your production, at the initial point, you see your cost per unit decreasing. But in a matter of time, there will be some expansion, there will be some more commitments, more challenges, and that will now cause you to incur more cost. And as a result of that, your cost of production per unit will begin to